Welcome everybody to today's topical talk on crypto assets, stablecoins and central bank digital currency. These come under the broad banner of digital currencies, something which is indeed very topical. Now, before our speaker demystifies these things for us, I'd like to begin by acknowledging the traditional owners of the lands on which we each meet this afternoon. I'd also like to pay my respects to elders past and present and extend that respect to any First Nations people among us today. We're coming to you from Gadigal country. Now, the notion of digital currencies has really captured the imagination of students because our high school students and most undergrads are certainly digital natives. Digital currencies are not part of the school curriculum, but because they fascinate students, educators are constantly faced with questions about them. And a core question that is relevant to the school curriculum is whether or not digital currencies are money. And economists are very much occupied with this question. So we hope that today's talk will increase your understanding of these rapidly evolving digital assets, what makes something money, and how central banks are approaching the issuance of digital currency. We've got educators logged in all around Australia with every state represented. It's especially pleasing to see that we've got teachers from regional areas. In fact, we've got people from Broome to Brisbane. So you'll hear today from Chris Thompson, who is the Deputy Head of Payments Policy at the Reserve Bank, responsible for our work on digital currency. Chris is going to speak for around 35 minutes or so, after which we will have a Q&A. Please submit questions at any time during the talk in the Q&A box. We may not have time to cover all of your questions. We'll at least try to cover the key themes, and submitting a question before the actual Q&A session will increase the chance of your question being addressed. But Chris, over to you.
Thanks, Jackie, and thanks to everyone who's online as well, joining this webinar. It's great to be here and to be presenting this webinar on, as Jackie mentioned, on crypto assets, stablecoins, and central bank digital currency. So just to go to the agenda for what I wanted to cover today, this is what I wanted to cover. So the first part of my talk will cover what crypto assets and stablecoins are. I'll talk about what they are, what the different types, the market size, and how they're used. I'll also talk about the question of whether crypto assets or stablecoins can be considered a form of money. And that will then lead me to a discussion on central bank digital currency, which I'll often refer to just by the acronym of CBDC. I'll talk about what central bank digital currency is, possible rationales for introducing it, design considerations that we're thinking about, and also I'll review the work that the RBA has been doing to date on central bank digital currency. So starting off then with the, I guess the key question, which is, what crypto assets, what are they? And as you can imagine, this is not a well-defined concept or even a sort of a homogeneous concept at all. But in high-level terms, it refers to a broad range of privately issued digital representations of value that you can transfer, store, and trade electronically. So unlike sort of something physical like banknotes, these exist as digital tokens or coins that people can hold in their digital wallets. I mean, I use the term in this talk of crypto assets because I sort of think that's a much more encompassing term for these sorts of instruments, but you will have commonly heard these sorts of instruments referred to as cryptocurrencies, digital currencies, or virtual assets, or even sort of more broadly as digital assets. The distinguishing feature of crypto assets is that they combine the use of specific technologies, namely cryptography and distributed ledger technology, of which blockchain is one example. And they combine those technologies to sort of create, verify, and secure transactions in these assets on a digital ledger, or like a database, that is distributed and synchronized across a number of what we call nodes, but they're essentially computers that could be spread around the world. And so it does this rather than relying on one central party to sort of operate and oversee the system. So they differ from the sort of centralized systems that are quite common for payments, where the record of transactions is held on a ledger or a database that's operated and controlled by a trusted central party, like a bank, for example. So crypto assets, they exist in decentralized systems where the ledger is distributed across a number of computers. So given this distributed nature of these systems, there needs to be some way of keeping this ledger or everyone on the same page about what the state of this ledger is, because you've got the ledger distributed across a number of different computers. So this is done via what is called a consensus mechanism. It's a way of validating transactions, adding them to the ledger, and achieving agreement among all the nodes what the state of the ledger is, and preventing the ledger from being tampered with or changed. So Bitcoin actually was the first type of crypto asset that was created in 2009, probably the one that many people are very familiar with. And it remains one of the most prominent crypto assets today. But there are actually many thousands of variations that have been created since, and probably similar numbers that have since failed or faded away. So the original purpose of Bitcoin was to enable people to be able to transfer value peer-to-peer without the need for trusted third-party intermediaries. So it was born out of a sort of a distrust, I guess, of central authorities and a desire for people to be able to make payments to each other free from any central control or the oversight of banks or governments. So that's the kind of the underpinning of where these things came from. There's some other additional characteristics of crypto assets that I think are worth noting. I mean, they're not issued by or backed by a central bank, a government, or other authority like that. They may or may not be backed by any assets at all, actually, or even be a claim on any person or entity. Some of them, such as Bitcoin, really have no intrinsic value. The only value they have is what somebody is willing to pay for them. And so users really have to trust in the software protocol that controls this sort of distributed system to have confidence that their holdings will not sort of disappear. As I noted, the market for crypto assets has expanded rapidly since Bitcoin was launched in 2009, and there are now many different types of crypto assets that have different characteristics, different purposes, and that confer different rights on the holders. So this slide attempts to illustrate some of the broad categories of crypto assets that exist today. Although I should note that there's no real sort of agreed taxonomy of how we classify crypto assets. So just running through this table here, we have some types of crypto assets called utility tokens. So these are sort of digital tokens that provide access rights to certain products and services on the platform where they reside. So it could be a digital token, for example, that if you hold, it confers, it gives you some right to a sort of a discount on a service maybe that is offered by that platform. So in that sense, there is some sort of utility from holding the token. We also have what could be broadly called security tokens. These are tokens that are sold to raise money for a new business idea or project, usually DLT or blockchain based. They generally come with a stake in the project and may have additional benefits such as voting rights or some rights to a share of the profits that are generated by that project. So in this sense, these security tokens actually resemble traditional securities like equities and bonds, and are often subject to securities regulation in many jurisdictions. We also have a category called non-fungible tokens, which have become quite popular in recent years. Now, these exist on blockchains as a record of ownership of a unique, tangible or intangible object, such as a song, a digital image, even an item of clothing, or even a house. So, each non-fungible token is unique. That's why they're called non-fungible. People can trade them as you would trade any other type of collectible. And there's only one owner of these tokens at any one time. Then we move on to what could be generically called payment tokens, or what many people actually refer to as cryptocurrencies. So these are generally decentralized crypto assets that are designed to function as a means of payment, as an alternative to traditional or fiat currencies. They're generally unbacked, they're not issued by anyone, and Bitcoin is the obvious classic example of this. And so finally on my list, I also have written here stablecoins. I'm going to come back to talk about these later, but they are another variation of crypto asset that aims to improve on many of the payment tokens that exist today. So what this shows is that there is quite a diversity in the range of crypto assets that are out there, and that the market is evolving and changing all the time. I wanted to turn now to look at the size of crypto asset markets. And so what I've shown you in this graph here is so this is a graph of the total market capitalization of crypto assets listed on CoinMarketCap, which is a popular price tracking website for crypto assets. As you can see in this graph, the market capitalization had increased quite rapidly. This graph only goes from 2020, but it has been increasing quite rapidly since the early 2010s. But it grew actually particularly rapidly during the past few years, reaching almost $3 trillion. This is measured in US dollars in late 2021. But as you can see, over the course of much of this year, actually, the market capitalization of crypto assets has declined quite substantially. That big run up in the market capitalization of crypto assets, particularly through sort of the latter part of 2020 and 2021, was really driven by what I call the crypto having its kind of mainstream moment. It became really front of attention for many people. There was a lot of media attention and discussion. A lot of new investor types were coming into this market. A lot of people were looking to get sort of exposure to crypto, households through to hedge funds. So we saw a lot of speculative, or that added to a lot of the speculative pressure on the prices of many crypto assets through this period. But the market, as I said before, has turned a fair bit since then, and we've seen this fairly big reduction in market capitalization of crypto assets this year. This has been driven, I think, by a combination of factors, including the fact that we're into a rising interest rate and inflation environment. There's been a general move away from risky assets by many investors. There's been increasing regulatory scrutiny on crypto assets as well, which potentially depresses the price. And there's also been some high-profile collapses of some crypto assets, and also some crypto exchanges, places where people can buy and sell crypto. And these events, I think, have shaken some confidence in the crypto asset markets and contributed to the reduction in market capitalization. In Australia, there's also been, in recent years, increasing interest in investing in crypto. The estimates of how widely crypto is held vary quite substantially, depending on the source and who's put the numbers together. But, for example, one survey suggests that around about 20% of Australians owned crypto in October this year. And then another survey from another source suggests that about 5% of Australians own crypto. So quite divergent range of estimates on ownership, but it is clear that there is an increasing interest from many households and many individuals in holding crypto. As I mentioned before, there are thousands of different crypto assets. In fact, I think something like about 10,000. But many have probably come and gone in the period of time since they first came about. This slide here shows the top 10 crypto assets by market capitalization. Just to give you an idea of just some of the sort of different types of crypto assets that are out there. So you can see at the very top there is Bitcoin. It was the first crypto asset, but also remains the biggest. It has a market capitalization of, at least of a few days ago, of almost $320 billion. This is US dollars. And that accounts for about a third of that total market capitalization of crypto assets. So Bitcoin remains a very big player in this market. Other big ones on this list that you may be familiar with include Ethereum. Actually, more technically, the cryptocurrency there is called Ether. Ether is the cryptocurrency that is on the Ethereum blockchain platform. That is the second biggest. You'll also see on this table here Tether and USD Coin, and also Binance USD. These are what we call stablecoins, which I'll be coming back to. They aim to maintain a stable price, and you can see that their price in this table is actually either $1 or very close to $1. Another interesting one in this table, if down at number 8, there is a crypto asset called Dogecoin. And interestingly, this crypto asset started as a joke in 2013 and is now in a category that people sort of call the meme coin. This has a market capitalization currently of nearly $13 billion. It was nearly as high as $90 billion in the past. So there's a very sort of highly enthusiastic trading community behind Dogecoin, but the price of this crypto asset has been quite susceptible to sort of celebrity tweets and other endorsements that have occurred. And the price has obviously been highly volatile. So you'll note from this slide that, that there's a large amount of concentration in the crypto asset market. The top 5 in this table account for 75% of the market capitalization, and this top 10 that you can see here account for 84%. I wanted to turn now to talk about some of the shortcomings with Bitcoin that have, appeared to limit its use as a means of payment, for which it was originally conceived. I won't go through these in detail, but I'll just sort of highlight these key shortcomings. One of these is price volatility. So the prices of crypto assets have been extremely volatile, and this next graph here shows you the Bitcoin price. This is BTC/USD compared to the Australian dollar US dollar exchange rate, which is in red. And you can see that the price of Bitcoin, this is measured as daily percentage price changes. The price of Bitcoin has been much more volatile than the Australian dollar exchange rate, for example. Then there's the second one on this list is lack of scalability. So the way that the Bitcoin system is designed using the blockchain technology, it can only actually process up to about 10 transactions per second. Now that's very low to effectively function as a means of payment for retail transactions. In comparison, if we look at the new fast payment system, retail payment system in Australia called the New Payments Platform that was launched a few years ago, that was designed to process up to 1,000 transactions per second. And if you also look at, say, the Visa card network, the International Visa card network, they have systems which can apparently process up to about 25,000 transactions per second. But that is a global card network designed to process global card transactions. So you can see that when Bitcoin can only process up to 10 transactions per second, it's clearly not very scalable and couldn't be used really very widely for retail payments. It would be just far too slow. The next item on this list is uncertainty about settlement finality. Again, because of the way the system is designed, it relies on what is called a probabilistic form of settlement for transactions rather than a deterministic form of settlement. So what that means is that the probability of a transaction being final increases with time. In fact, with the Bitcoin network, transactions are really only considered final after about 1 hour. But this is not very useful. For example, if you are using Bitcoin to buy a car, when immediate settlement is really key. Otherwise, you're not going to be able to drive away with the car. Another problem that's getting a lot of attention recently relates to the energy intensiveness of the Bitcoin system. The Bitcoin system uses a form of consensus, which I mentioned earlier, which is called proof of work. And that is used to agree on the state of the ledger amongst these decentralized nodes. And what this involves is a process whereby some nodes called miners actually compete to solve a computationally intensive puzzle, which consumes a lot of computing power for no real benefit. And the idea is that the first miner to actually solve the puzzle gets to add the next block of transactions to the blockchain. But in the meantime, all of those computers that have been competing have been using up a lot of very expensive energy trying to solve the puzzle. And then once the puzzle's solved, they move on to the next block. So this has been contributing to it contributes obviously to a lot of energy usage. And some people estimate that the energy usage of the Bitcoin system is equivalent to the energy usage in some mid-sized countries like Norway or Argentina, for example. And this is potentially contributing to a lot of global emissions. And finally, a point that I want to make is that despite being a sort of decentralized system, the way that many people access and trade Bitcoin and also many crypto assets is actually via services that are offered by intermediaries, such as digital wallets and exchanges. And this reliance on intermediaries means the system is susceptible to the problems that any intermediaries in financial services can create. The risk of bad actors, fraud, hacks on intermediaries, etc. And the problems here are magnified because many of the intermediaries that operate in these crypto asset markets are currently unregulated. So, given some of these problems that with Bitcoin that I've mentioned, and particularly focusing on the one around sort of the extreme price volatility, that has sort of undermined Bitcoin's use as a means of payment. And this has encouraged people to develop new types of crypto assets that seek to overcome this problem. One type of crypto asset that's been developed to try and address the price volatility of Bitcoin and other ones like it are called stablecoins. So as shown on this slide here, a stablecoin is a type of crypto asset that is specifically designed to minimize price volatility against a widely used unit of account or store of value, such as a national currency, most commonly the US dollar, or against a commodity such as gold. So this is designed to make these crypto assets, or these stablecoins, more money-like, and also make them more attractive to use as a store of value and a means of payment. To date, actually, if you look at how stablecoins have used, they've primarily been used to facilitate trading in crypto assets, where they're often used as a bridge between national currencies and other crypto assets. So using stablecoins to transact in crypto asset markets reduces the friction, also reduces the need for market participants to convert their funds into and out of national currencies, which can incur fees and take time. So people often will buy stablecoins with their national currency, for example, the Australian dollar. That gives them their entry to the crypto asset market. And from there, they will buy and sell crypto assets and come to and from stablecoins as the sort of safe asset whilst they're deciding what to do with their funds next. And it avoids them having to come back out into fiat currency. So that is the primary way that stablecoins are being used today in crypto asset markets to facilitate essentially speculative activity in crypto markets. They're not being used to any significant extent in the to pay for goods and services. There's two broad types of stablecoin, these types relate to the mechanism that they use to maintain a stable price. So first, we have asset-backed stablecoins. These stablecoins, or otherwise called collateralized stablecoins. So these seek to maintain a stable value by backing the coins on issue with real or financial assets. Holders of the claims of the stablecoins have a claim on and may be able to redeem their coins for the reserve assets. And so the idea here is that if a stablecoin is fully backed by safe assets, then if the price of the stablecoin deviates too much from the peg, that would give rise to potentially an arbitrage opportunity for somebody to come in and buy it below the peg, knowing that they have the ability to access the assets that are fully backing the stablecoin. So that should keep the price of the stablecoin at its peak. I emphasize should here because one of the issues with asset-backed stablecoins is that some of them are not fully backed by assets. They may only be partly backed. And also the quality and the composition of the reserve assets that are backing these stablecoins, and also the transparency that there is around those reserve assets can differ quite substantially across stablecoins. So there are risks to investors around how safe these stabilization mechanisms really are. The other type of stablecoin is an algorithmic stablecoin, also called an uncollateralized stablecoin. So these are not backed by assets, but instead they seek to maintain a stable value by adjusting the supply of the stablecoin on issue in response to changes in demand through various types of algorithms or incentive mechanisms that are built into the system. Now, one common structure for these stablecoins is a two-coin structure, whereby a linked coin is used to absorb market volatility allowing the main stablecoin to hopefully maintain its peg. The main issue with these algorithmic stablecoins, though, is that they really rely on investors being willing to hold, in the case of the two-coin system, the linked stablecoin, or the linked crypto asset. And it also relies on the presence of sort of independent and rational investors who can perform this price stabilizing arbitrage that exists in these models. But those conditions don't necessarily hold, and actually these algorithmic stablecoins can be inherently fragile. Looking at the size of stablecoin markets, this is a graph of market capitalization of stablecoins, showing the biggest ones that exist at the moment. The overall market capitalization of stablecoins is currently about $140 billion US, but that's come down from a peak of about 185 billion US dollars in April. As you can see in this graph, the biggest stablecoins are actually denominated in US dollars. So we have Tether, US dollar coin, and Binance USD, which you saw earlier on the graph of top 10 crypto assets, and they're all examples of asset-backed stablecoins. I've also shown on this graph here at the bottom a line called Terra USD. This was an algorithmic stablecoin, which earlier in the year was one of the largest such algorithmic stablecoins in existence at around $20 billion, and it collapsed spectacularly earlier in the year as a result of significant investor withdrawals and an apparent breakdown of its stabilization mechanism. I would note that there's been very little issuance of Australian dollar denominated stablecoins to date. However, there is increasing interest in this market. One of the major banks, for example, has been piloting an Australian dollar stablecoin that's backed by deposits at that bank. And there's also been a few entities recently, some non-bank entities that have been looking to issue Australian dollar denominated stablecoins, but these remain very small. So stablecoins are designed to maintain a stable value, but just how stable are they? Well, this graph here shows the prices of a number of stablecoins, Tether and US dollar coin, which mentioned before, the two largest asset-backed stablecoins. Generally, you can see that these stablecoins have maintained their peg at around $1, which is $1 US, which is the peg they're trying to achieve. But there are some examples where they've dipped a little bit below that $1 mark. And the other comparison in this graph is, as I mentioned before, is Terra USD, which was an algorithmic stablecoin. As I mentioned before, it underwent a spectacular crash earlier in the year, lost its peg, and eventually the price essentially fell to close to zero. This crash occurred amid broader volatility in crypto asset markets, and investors suddenly lost their confidence in Terra USD with the breakdown of the stabilization mechanism. The small blips that you see with Tether, where the price fell below the $1 peg, they reflect some episodes where I think investors have sort of been a bit unsure about the quality of the assets that have been backing Tether. And this has been an ongoing concern for many investors as to the quality of the assets, and the people involved in organising the Tether stablecoin have not necessarily been very forthcoming with the information on the quality of the underlying assets. So I'd like to turn now to consider that question that we posed at the beginning, which is, are crypto assets a form of money, or should we consider them to be a form of money? As we've noted, some people refer to crypto assets actually as cryptocurrencies or digital currencies, which seems to imply that they're a form of money and are being used as a form of money. But it's good to test that assumption. In economics, we think of money as having three characteristics. That money is widely accepted. The form of money is widely accepted as a means of payment. It's a good or safe store of value, and it's a widely used unit of account. So how do crypto assets compare against these characteristics? Well, in terms of means of payment, we find that crypto assets are very rarely used as a means of payment for goods and services. There's very few merchants that accept payment in crypto, not even in stablecoins. There was a trend a few years ago for some merchants to start accepting Bitcoin for payment, but that seems to be a bit of a fad that never took off. And today it's quite rare to be able to find a merchant that accepts payment in Bitcoin. In terms of store of value, the volatility in the prices of crypto assets, which we've talked about, means that they are not a very good store of value. Large fluctuations in the prices of crypto assets mean that their purchasing power changes, is not maintained over time. One day it might take 2 crypto asset tokens to buy a loaf of bread. Tomorrow it might take 4 because the price of the crypto asset has suddenly depreciated. So that volatility in price has reduced the effectiveness of crypto assets as a store of value. Obviously, stablecoins have tried to address that, as we've talked about, and they aim to be more stable, but that also depends on the stabilization mechanism. And finally, on unit of account, by this we mean how common is it for this crypto asset to be used as a means of payment, to be used as a means for measuring the value of goods and services. So, i.e., do merchants price their goods and services in crypto assets? And the answer to that is, not at all or not very much. In Australia, pretty much all prices for goods and services are quoted in Australian dollars, which is the main unit of account. So overall, I think if you look at the box there, we can conclude that, it's fair to say that no crypto assets, including stablecoins, currently display the main characteristics of money in Australia. But the emergence of DLT, or distributed ledger technology, as well as cryptocurrencies, as well as the sort of broader digitalization of the economy that's happening, has raised the question of whether there are other forms of digital currency that could better function as money in the future. And one type of digital currency that could do this, or would do this actually, is central bank digital currency, or CBDC. And that's what I want to turn to now. So I want to start this section off by talking about the main forms of money that currently exist, and then look at how these compare to central bank digital currency. So we've shown here a diagram, which is a Venn diagram that shows how you can classify different forms of money based on 3 characteristics: whether it is issued by the central bank, which is the blue circle, whether it's universally accessible, which is the red circle, and whether it's digital or electronic, which is the green circle. So obviously the intersection of these circles shows forms of money that share different characteristics depending on which circles are overlapping there. So if you look at the situation we have today, so we essentially have 3 forms of money in Australia. We have cash or physical banknotes and coins. Clearly they're not electronic, so they're outside the green circle, but they are issued by, well, banknotes at least are issued by the central bank, issued by the Reserve Bank of Australia, and they are universally accessible. They can be held by anyone. But actually, in most advanced countries, as in most advanced countries, most of the money in Australia actually exists in digital form as deposit balances recorded in electronic ledgers or databases. So the bulk of this digital money is in the form of deposits of commercial banks, and these deposits are a liability of commercial banks, not the Reserve Bank, so they do carry some additional, although still very low, credit risk. And then individuals can use the electronic payment services provided to them by their banks to make payments with their deposits. The Reserve Bank also issues digital money currently in the form of balances in what are called exchange settlement accounts that banks and a few other types of entities hold with the Reserve Bank. Exchange settlement account holders can use their balances to make payments to other exchange settlement account holders. So currently, individuals do not have direct access to a digital form of central bank money. If they want to hold central bank money, then they need to hold banknotes in Australia. So to put these different forms of money that exist today in context, the total money supply in Australia is currently about $3.3 trillion. And the sum of the 3 sources of money shown above, so that is the sum of the 3 sources of money shown above. And the commercial bank money component of that is 83%, whereas the currency or cash component is only 3%. So the vast bulk of our money supply today is digital balances held in commercial banks. If we look to the future, then when we talk about central bank digital currency, what we're really talking about is a new form of digital money that's issued by a central bank that would be more widely accessible than exchange settlement account balances. So looking at this right-hand side of this graph now, we're distinguishing here between a potential retail central bank digital currency which would be universally accessible and almost like a digital version of cash. And then we also distinguish here with a wholesale central bank digital currency, which would be accessible only to a more limited range of participants, but probably including some that do not have access to exchange settlement accounts currently. So these are the two sort of forms of central bank digital currency that many central banks are considering. And in considering central bank digital currency, there's many questions that need to be answered. You know, do we need a central bank digital currency? What problems would it solve? How would you design it? And then these are many of the questions that the research on central bank digital currency is currently trying to answer. So I want to talk now just quickly about some possible motivations or rationales for a central bank issuing a central bank digital currency. Different countries will have different put different weights on these rationales. The first one here is strengthening financial inclusion. So some low-income and developing countries where many households are unbanked, this is a key motivation for thinking about central bank digital currency. So they're basically seeing central bank digital currency as a way to help overcome some of the gaps that the private sector hasn't met. This argument is less relevant to Australia because we have a highly banked population and a rapid adoption of electronic payments in this country. And the use of physical cash for payments has actually been declining. The second point is on supporting universal access to public money when cash becomes hard to access. The argument here is that central banks should continue to provide a safe form of money as cash declines, so people have an alternative to commercial bank money. But if cash were to go away, then the only money that people would have access to is commercial bank money. So some people argue that the public sector should provide a form of money that people can access even if physical cash goes away. This is not really a big argument for Australia at the moment because we still have, even though the use of cash for transactions has been declining, there is still a lot of cash available. The amount of cash in circulation in Australia is still very high, and access to cash services is still quite good. So we're not in a situation in Australia where physical cash is going away very quickly. So this tends to be a sort of weaker argument for whether we should be thinking about providing a central bank digital currency in Australia. Other arguments that are raised about why we should have a central bank digital currency. One is that it could strengthen competitive pressure on the private sector on private sector payment service providers. So particularly if cash declined, there could be less competition in the market for payment services, which could lead to worse outcomes for households and businesses in terms of sort of high prices, poor services, or less innovation. So a central bank digital currency in that environment could help improve competition in the payment system. A related point to this is on a CBDC potentially providing a stimulus for payments innovation. The idea here is that a CBDC could serve as a platform for innovation that lowers barriers to entry for firms and spurs innovation in payments. Another point I think that's interesting is enhancing resilience of the payment system. So if you had a central bank digital currency, it could be an additional source of redundancy if there's outages in the other electronic payment systems, or even if the cash distribution system was prone to disruptions. In order for a CBDC to play an effective role there, it would really need to be designed in a way that was sufficiently different to existing electronic payment systems to be fully resistant, and potentially also it would need to function without power and electricity, without power and telecommunications. So that would create technical challenges. And the final point I wanted to note is around argument that's been raised, which is that you need a CBDC to safeguard monetary sovereignty. The argument here is that if you don't have a central bank digital currency, but other countries, for example, do, or that stablecoins become quite popular, people may decide to hold a foreign central bank digital currency or a stablecoin because they don't have access to a domestic one, and they might see some functionality benefits from doing that. And that would essentially amount to some sort of form of currency substitution, which would complicate the conduct of monetary policy and the safeguarding of financial stability. I think here the point to note is that the history of currency substitution in other countries indicates that it's more likely to occur in economies where institutions are not as strong and the population has a good reason perhaps to question the value of the domestic currency. And I don't think those conditions exist in Australia. So overall, when we look at these arguments, possible rationales for issuing a central bank digital currency, the way I view this is that cash is still readily available in Australia. There's still good access to cash. People are content to hold the majority of their money in commercial bank accounts and avail themselves of the electronic payment services that are provided to them. And we've seen a fair amount of innovation in our payment system in recent years. So overall, this suggests to me that there's not a strong case for a retail central bank digital currency in Australia now, although we have to have an open mind to the possibility that a case could emerge in the future. And that's what's really prompting all of our research in this space at the moment. I just want to turn now to talk about some of the research that other central banks have been doing in this space, and just to note that actually many central banks are actively researching central bank digital currency. So these graphs here are based on a survey from the Bank for International Settlements, a survey of central banks' engagement in CBDC work. You can see on the left-hand side there that there's been a big increase in the share of central banks that are doing work on central bank digital currency. Currently, about 9 in 10 of central banks are actively engaged in this field. And then you can see on the right-hand side that actually their interest in CBDC is both wholesale and retail use cases, but also some are just looking at sort of retail use cases. Very few central banks are just focusing only on wholesale CBDC. So I guess the point to make here is just that there's a lot of interest in researching central bank digital currency among the central banking community, and we're also very engaged in that as well. I just want to quickly highlight here some of the issues that we would need to consider if we did decide to introduce a central bank digital currency. So these are some of the questions we would need to work through, and we haven't answered these questions, but it gives you a flavour of the sorts of challenges we would confront. Questions like, what technology would you use? What role would there be for the central bank versus the private sector in the distribution of a CBDC? Who could hold the CBDC? This is the question of retail wholesale, but also the question of, for example, would you allow foreigners to hold a CBDC? Would you allow allow a CBDC to be used only for in-person transactions, for online transactions, or even on offline usability? Another question, which would be probably quite contentious, is the question about what degree of anonymity and privacy would apply to transactions in central bank digital currency. It's quite likely there that even though cash today is an anonymous payment mechanism, it's probably hard to make a case that a CBDC should also offer the same degree of anonymity as cash currently does. And then there's a question of, would it earn interest? Obviously, our starting point would be that it wouldn't, because cash doesn't earn interest, but there are some arguments that people put forward that it should earn interest. Let's now to focus quickly on some of the work that the RBA has been doing on central bank digital currency. And we've actually been doing research in this space for about 5 years now. And what I've done in this slide is give you a bit of a timeline showing some of the key milestones in our sort of CBDC research journey and some of the key pieces of work that we've done. And I'll just highlight just a couple of these. We've done some thinking around the case for a central bank digital currency in Australia, and particularly I point to the Bulletin article we published in 2020 where we talked about a retail CBDC. We explored some of the design considerations, the rationales and potential implications of a central bank digital currency. But we've also done some technical research as well. We've actually developed proofs of concepts, or what you could call prototypes, of what a central bank digital currency could look like. These have actually leveraged off the distributed ledger technology that's been quite common in the crypto market. We did one of these projects in-house in 2018 to 2019, which was called our settlement token project. And we also did a bigger project along these lines in 2020 to 21, which was called Project Atom, which we collaborated with a few banks and other entities and extended that proof of concept that we developed earlier. So this I really characterize as sort of technological experimentation that we've been doing, and thinking about some of the design aspects of central bank digital currency. I want to move on to talk a little bit more about this slide, which is that a major project that we have underway at the moment on central bank digital currency. So this project we're doing in collaboration with the Digital Finance Cooperative Research Centre, And it's exploring use cases for and business models for a CBDC that, or business models and use cases that could be supported by the issuance of a CBDC in Australia, and also trying to measure the potential economic benefits of introducing a CBDC. To do this, we've developed and will shortly launch a limited scale pilot CBDC that will operate in a ring-fenced operating environment for a period of time next year. The pilot CBDC is designed to be a real claim on the RBA, not like some of these prototypes and proofs of concept that we've done in the past, where the CBDC in those models is very much a sort of a fake CBDC. This pilot CBDC will be a real claim on the RBA, issued in a limited amount and operating within a controlled environment. And having stood this pilot CBDC up, what we've done is invited industry participants to submit ideas on use cases for the central bank digital currency that they would like to develop and operate within our pilot CBDC environment. We've actually seen a lot of interest already from industry in participating in this project. We had about 140 submissions made to us of different use cases for a central bank digital currency. We're in the process of selecting some of these use cases to participate in the pilot next year. And they will develop their use case that leverages the pilot next year, as I mentioned. And there's a lot of interesting use cases that have been suggested to us. As I said, we're just going through the process of selecting them. And then coming out of this project at the end, we will have hopefully seen a number of different use cases demonstrated and be able to think about what are the sort of compelling use cases and where is the value added use cases for a CBDC that might exist for Australia. And this will help build the evidence base, I guess, on whether Australia should have a central bank digital currency. And then just to my final slide then. So as I mentioned, we've got this pilot CBDC project underway that will help us learn about use cases and potential benefits of a CBDC. That will likely feed into further work that we're going to do to review the viability and feasibility of a retail CBDC. And then based on that, we'll see whether there's a strong enough case to develop a CBDC in Australia. It obviously would be considerable work to design and develop a CBDC if a decision was ever made to do so. Be a major system that would need to be developed and would involve the private sector and a lot of other stakeholders. And we also need to think very carefully about what the implications of a CBDC might be for the financial sector if we were to introduce one. So hopefully what I've done here is show you that we are taking our work on central bank digital currency very seriously. We're doing a lot of research and thinking in this space. We're trying to work out if a CBDC would be in the best interest of the country and would make improvements over our existing monetary and payment systems. And this work will continue over the coming years. But the final point that I wanted to make at the end is to sort of say that we still have physical cash in Australia and it's not going away anytime soon. As the issuer of Australia's banknotes, we remain committed to ensuring that Australians continue to have access to physical cash for as long as they need or want to use it.